Good morning. How y'all doing? Can you hear me okay? I appreciate you having me. I am always honored when someone thinks enough of me to ask me to share some of the things that I love sharing. So Myron was correct, or Pastor Edmonds was correct. You can leave there. That's good. This is something that I enjoy doing. I love sharing financial literacy. I am not a pastor, but we are in a church, and I promise you this will not be too much of a sermon, but I do want to make sure that some of the things that we talk about this morning have some connection, that you can see the connection to not just the Bible, not just our faith, but how we can use our faith to present more opportunities to ourselves, right? It's not just what can you do, it's what are you prepared to do when an opportunity arises. So we're going to talk about something called 10 talents this morning. Now, as Myron shared, we're going to do the first part of this was going to be more general finances. We'll take a break for question and answer, and then we will talk about student loans specifically. But for this first part, we want to make sure that we have some things that are relevant to everybody. Amen? All right, so I will direct you. Do I just say next slide? Does that work? All right, next slide. All right, so I want to talk about some of the things that you see when it comes to financial media and what the reality is. And we're going to do this under the framework of the parable of the talents. Anybody familiar with this parable? All right, next slide. Let's talk about this scripture, and I want to leave in the blank something that you may be able to fill in. Maybe you can't fill it in. I was never that good at Bible Bowl. That's the only reference that I'll have. But to me, this is something where you've seen this scripture probably 1,000 times, but I want to read it and I want to leave a certain part blank. And there's a real intentionality to this. It says, "For it will be like a man going on a journey who called his servants and entrusted to them his property. To one he gave 5 talents." How many? 5. To one he gave 5. To another he gave how many? 2. To another, how many? Now, a talent is a measurement of gold. This is not like talents and abilities, although that is relevant to what we're talking about. Right now, we're actually talking about money, right? And this is something that we're afraid to talk about in the church. It's an icky conversation. Why are you talking about what I earn? And this is not about, hey, we all have to be rich. But there is something to what he said last night. There's a difference between being rich and being wealthy. And we're just talking about being good stewards of the opportunities that are presented to us. And money just happens to be a way that we can show our stewardship. So one gets 5 talents, another 2, another 1, blank. And then the master went away. Next slide. Now, we're going to talk about this in this slide, but we know, and if you don't know the parable of the talents, essentially the person who had 1 talent didn't do anything with the talent. We'll talk about that towards the end. But he didn't save it. He didn't invest it. He didn't start a business with it. We're going to get to the end of the story where we talk about why. But one thing that I want you all to keep in mind is this. To me, when people tell Bible stories and there's a protagonist and an antagonist, a lot of times we've heard the story so much that we only think about the protagonist, the good person's perspective, right? We listen to the parable of the lost coin. We listen to the parable of the prodigal son, and we talk about the loving father who is so overcome with the fact that his son came home that he gives him and runs to him and gives him a big embrace, right? We talk about that. We talk about the son who humbles himself and comes back to his father and said, "I will be one of your servants." We talk about that. But we judge the other brother who gets upset when the brother who left the house and spent his inheritance comes back and gets a party, and the other brother's upset about it, right? That's the person that we judge. But I want you to think about how you would feel in that scenario, right? If you're telling me that if your sibling left and you stayed home, and your sibling wasn't working and you were working, and your sibling got the money that you were due early and then blew it all and came back home and got a party for it, and you tell me that that wouldn't make you upset, that just tells me you don't have any siblings, right? Like, to me, you have to think about the perspective of some of these people. So now let's think about the person who got 1 talent. He got 1/5 of what the servant who got the most money received, right? Now, towards the end of this parable, There's a part of this scripture when the master asks, why did you not do anything with your talent? And the servant says, Master, I knew that you are a hard man, harvesting where you have not sown and gathering where you have not scattered seed. So I was afraid and I went out and hid your gold in the ground. See, here is what belongs to you. What this tells me is this is an employee who has been passed over for a promotion and is upset about it and said, you know what? Here's your money back, right? Like, you're not going to trust me with anything. This person's more credentialed than me and I don't believe it. So what do you want me to do? I'm just going to sit and just do my job and I'm going to go home at 5, right? That's what I hear from this story. So now let's talk about how this projects to the reality of people's finances, the opportunities there's presented versus what we're presented. What you're looking at on this screen, and there's a reason I left it up so long because it's very hard to read, is from JP Morgan Chase. It's called a retirement savings checkpoint. These numbers are really small. We're going to have bigger examples in a second. The premise of this is that you are supposed to find the income on which you want to retire at the top. So you see 50,000, 75,000, 100,000. That's the income on which you want to live in retirement. On the left-hand side, you see your current age, or at least the year closest to your current age. And what you do is you find where those tables intersect, and it tells you how much you need to have saved at that age. That's a mouthful, but this will become more clear. As an example, if you want to live off of $75,000, then by the time you are age 40, you need to have 240% of that number already saved. This came out and now comes out every year, but it's just a way to see how much should I have saved at any particular age if I want to retire. Next slide. This will make it much more clear. So these are some of the numbers where you see what you should have at certain ages. If you want to live off of $100,000 a year in retirement, by the time you're 25 years old, you need to already have $60,000 saved. Do any of you know anybody who already had $60,000 saved at age 25? By 35, you need to have $200,000. By 45, $400,000. By 65, to live off of $100,000 a year, you need to have $1.3 million saved. Now let's look at what the reality is of most people's situations. Next slide. What you're seeing on the left are the numbers I just told you. What you're seeing on the right is the median amount people actually have saved at these ages. At 25, the median amount people have saved is $11,000. At 35, you're supposed to have $200,000. People have $28,000 saved. At 45, you're supposed to have $400,000. People have $48,000. A little more than 1/10. And at 65, people are supposed to have $1.3 million. People actually have about $70,000 saved. You know what this reminds me of? Does anybody remember those ING What's Your Number commercials? Where people would walk around and there would be this floating orange number over their head. And the premise of it was that's supposed to be the amount that they need saved by the day they retire in order to have a fulfilled retirement. You see a school teacher in class and she'd have $430,000 floating over her head. Like, these are the numbers that you are being told you have to have. And if you see this online, if you see this on a commercial, does this help you with your money or does it depress you? It depresses you. What are you supposed to do if you don't have these numbers? You can't just magically say, oh, well, thank you. Now that I have that knowledge, everything's better. Next slide. Here's what they assume when they put those numbers together. Next slide. This came out and went viral a few years ago. It's the ideal budget. It's actually by a guy named Pete the Planner that I truly believe is an excellent person of financial literacy. This budget, however, I disagree with. This is showing the ideal amount or percentages that you should put towards different parts of your budget in order to be able to save and invest. 25% towards housing, 15% towards transportation, 12% towards groceries and dining, 10% in savings, 10% towards your utilities, 5% towards charity, 5% towards clothing, 5% towards entertainment, 5% towards medical. Don't think they're aware of how much health insurance costs these days. 5% towards holidays and gifts, and 3% towards miscellaneous. But let me tell you what you don't see on this budget. Does anybody see a credit card payment? Does anybody see daycare? Not for 3%, not miscellaneous. Trust me, I got a 5-year-old. It's not 3%, right? No student loan payment. Not on here. So what are you supposed to do if you still have to hit these metrics, but you have all these things in your budget that they don't have in the ideal budget? Next slide. What's reality? What are we actually dealing with? Next slide. An article came out 2015 by The Atlantic. It was entitled, "Why So Many Minority Millennials Can't Get Ahead." And in this article, they did an in-depth expose of some of the things that people now in all generations, because I will tell you this, everybody's struggling, regardless of race. It just so happens that minority communities are almost like a canary in the coal mine for what's going to happen to all communities down the line, right? The struggle hits us first, and then it peters out and trickles out, right? So in this article, next slide, they found some statistics about what wealthy people do to acquire and accumulate wealth. And they found that for the typical wealthy person, here's how they have their wealth distributed and how they received it. 20% came from formal and informal gifts. 60% comes from equity in their home, and 20% came from personal savings. So for all that stuff we saw on the previous screens about the amount we have to have saved in order to be wealthy, The Atlantic found out that over 80% of wealthy people's wealth didn't even come from them. It came from somebody else or a home that just happened to appreciate in value. And they were only responsible for 20% of it. Now let's compare that to our availability towards that 80%. Next slide. Upwards of 80% of Black parents and 70% of Latino parents expect that they will need their children's financial assistance in retirement. They're not giving gifts. They are expecting to be supported, not because they're selfish, because they have to be supported. White Americans are 5 times more likely to receive an inheritance than other minorities. Now, that may make you mad, but understand this. Inheritance is not $1 million. Inheritance is, I need new tires, and my dad can help me with it, or my mom can help me with it. That's the level of inheritance they're talking about, and we just don't even have that. Compared to minorities who receive an inheritance, the value received by white Americans is 10 times higher. Next slide. Minority homeownership rates are almost 30% lower than white households. Even amongst minority homeowners, their first purchase comes later and at higher interest rates than their white counterparts. Now, there's statistics that you see here that are even crazy when you talk about, like, take race out of it, even insert gender. There's statistics that show that women save more than men. They save a higher percentage of their income. They invest in a similar way and end up with half as much money. There's plenty of reasons why. They have a parent who's sick, and if someone has to leave the workforce for a few months to take care of them, it's typically the woman. And during that period, they can't save. Maybe they leave for childbirth or childcare, whatever the case may be. There's all types of statistics out here that tell you what people are actually dealing with. Next slide. Over 78% of Hispanic Americans and 95% of African Americans have fewer than 3 months' expenses saved. Next slide. This is the last one we'll cover before we get to the actual meat and potatoes of how to flip this around. Student loans. Next slide. This to me is insane. The study found that Black young adults take on 85% more student loan debt than their white counterparts. And that growth, that gap between the two, compounds by 7% every single year after they leave school. This is a real struggle. Next slide. So here's what we're actually dealing with. I call it the competing dollars dilemma, and every community deals with it. Trust me, there's a far fewer percentage of people out there who are not dealing with this than there are who are dealing with it, right? So competing dollars means that I have $1 and I'm looking at that ideal budget, and I have these percentages in this ideal budget that I have to wedge in, and there's no way to wedge them. So what happens is I have $1 and I'm trying to use that $1 to save for retirement, to educate my children, keep them safe, be charitable, and somehow enjoy life. And it's hard to do. So what we need to do when we have that $1 is the concept of something called taking one arrow and shooting at multiple targets, right? We only have one arrow in the quiver, but we have to find a way to use that arrow to somehow hit multiple targets. Next slide. Now, let's go back to this text. He who had received the 5 talents went at once and traded with them, and he made 5 talents more. That's what we're trying to do. We're trying to find a way to make more talents out of the ones that we have. So also he who had the 2 talents and made 2 talents more, but he who had received the 1 talent went and dug in the ground and hid his master's money. Next slide. So how do we catch up, right? We've talked about where we are. How do we take that one arrow and make it hit multiple targets? Next slide. Now, there's a big fat loans in the middle of this slide, and I want to tell you why. In my experience of working with families, businesses, I probably work 49, 50 weeks a year, probably meet with 10, 15 families a week, every week for 15 years. That's a lot of people's finances that I've seen. And I can tell you that often some of the things that have catapulted families into another financial stratosphere are things like getting a degree, an undergraduate degree or a graduate degree that radically improves their ability to earn an income, right? Maybe they sold a home that greatly appreciated in value. They could have started a small business. They could have sold or purchased an investment property. Maybe they paid off a large debt like a mortgage or a student loan. And even in that scenario, when you talk about these financially life-altering events, at some point in time, these people had to qualify for a loan, right? Now, this is not telling you to go take a loan. It's saying that you have to financially qualify for most loans, which means that you have to put your financial balance sheet in the condition that a bank or a lender would look at you and say, you are a good bet to loan this money to, right? So if we can use the principles that a bank uses to determine who is a good bet, we can use them for our benefit without borrowing the money. You see what I'm saying? Like, what does the bank look at to see whether I'm doing the right things financially? And how do I implement those characteristics in my finances without borrowing the money, right? So that's what we want to do. Next slide. Why does this matter? Next slide. Here's what a bank expects when they are evaluating an application. They expect that when they look at the capital that you've had access to, that you have used it wisely, that you have not overspent. That's what credit is. It is you had access to this thing. How good of a steward were you with it? That's part of it, all right? They want maximum liquidity. I hate to tell you this, a bank really does not care too much about you. They care whether you can pay them back. That's the extent of how much they care about you. So they want to make sure that you have maximum liquidity. If a storm comes, if an emergency arises, does this person still have the money to pay me back? They want to make sure that you have consistent positive improvements in net worth, meaning are you moving in the right direction? Or 3 years into this loan, are you going to be worse off financially than when you started? Because that means that you may not be able to pay us back when the storm comes. And they want to make sure that you have protection from death, disability, and creditors. Not them, they want their money, but other creditors, right? Do we have first stab at getting our money back? Or is there someone else ahead of us who could take this money before it gets to us, right? So we want to make sure that we have all of these things addressed in our financial life so that we can use them for our benefit without having to borrow the funds. Next slide. So let's talk about using capital wisely. My goal is to give you actionable steps. The ideal is to not be running out there with credit card debt at all. But that doesn't change the fact that a lot of us have it right now, right? So I want to make sure that you have actionable steps that I believe you can implement today, this month. And while we're moving towards the ideal objective, you have some things that can benefit you in the here and now. So let's talk about using capital wisely. We're talking about credit. These are the elements of a FICO credit score. 35% is your payment history. Literally just, do you pay your bills on time or not? It's the largest element of your credit score. No matter what anybody tells you, the best way to have good credit if you're starting out is to just pay the bills that you have on time. 30% is credit utilization. Credit utilization is a measure of how much of your available credit you have borrowed at a particular point in time. There's a reason I place emphasis on that. I didn't say how much of your credit you've borrowed. I said how much of your credit you've borrowed at a particular point in time. 15% is the age of your accounts. The older your credit is, the better. 10% is the mix of your credit. If the only type of credit you have is credit cards, you don't have a good mix or blend of your credit. And then 10% is credit inquiries. How many people are checking your credit? You don't want people checking your credit for just no reason at all. Now, there's a reason that I have credit utilization highlighted on this screen. Can anybody take a guess as to why? Go ahead. So it said, when it's high, your credit drops. That is accurate. One more, that's not exactly what I'm looking for. That statement is accurate. But is there anyone else who has a guess as to why it's highlighted? It is what we're struggling with. I'll give you the answer. The reason this is highlighted is because it is the only element of your credit that you can positively impact within 30 days' time, right? You cannot change your payment history overnight. You've either paid on time or you haven't. You can't change the age of your accounts in a positive way overnight, only in a negative way. You can't change your credit mix or your credit inquiries in a positive way in 30 days, only in negative ways. Credit utilization is the only part of your credit score that you can change in a short period of time in the positive. So what are some ways that we can do this for people who are currently struggling with credit card debt? Next slide. If you're not struggling with credit card debt, don't go get credit card debt just to implement this, right? This is for people who are trying to, while they're paying things down, not sacrifice their credit score while they're doing it. There's a rule with credit utilization called the 30% rule. And it says that when you look at the credit you have available, if when they check your utilization, you have borrowed more than 30% of it, your score starts to go down. As an example, if I have $10,000 of available credit, and at the time they check my utilization, I've borrowed $5,000, then I have a 50% utilization ratio. That's way too high. So my credit's gonna go down. The goal is to not have it high at all. In fact, most people who have perfect credit on average have borrowed less than 10% of their available credit when checked. But 30% is kind of that line in the sand where if you're over that, we're in trouble, okay? Now, let's talk about the difference between when it's checked versus when people think it's checked. When you have a credit card, there's a difference between what's called the statement date and the payment date. The statement date is the last day where they look at how much you've borrowed over the previous 30 days. So let's say that your statement date might be February 14th. Well, you get a bill on February 15th that says, here's how much you spent over the previous 30 days. And the payment date is the date by which that payment is due if you want to avoid interest. Bear with me. You get a bill on February 15th that says that you spent $1,000. That's the statement date. They'll say if you pay this off by March 10th, you won't owe any interest on that $1,000. That's the payment date. So what most people do is they get their credit card statement and it says, I owe $1,000. I need to make sure that my credit utilization is strong. So I'm gonna pay down this $1,000 by March 10th so I don't pay any interest. And then my credit utilization could be strong, right? I paid it off before the payment date. What most people are not aware of is that when they assess credit utilization, they use the number on the statement date. So it doesn't matter if you pay that off on time. If when they check what you borrowed in the previous 30 days, it's high, your credit utilization is going to be high no matter what. I'll give you an example. Next slide. So January 15th to February 14th, you see that on this slide? This is a sample of a statement cycle. That's the period of time that they're assessing what you've borrowed. You get a balance on the statement at the end of that period, February 14th. If you pay it off between then and March 10th, there's no interest that's due because that's the payment date. Next slide. So in the example that we just gave you, $1,000 is reported to the credit bureaus on February 14th, and even if you pay it off in full by March 10th, you still have that $1,000 on your credit utilization. So let's say that while you are trying to get your credit in order, while you're paying it down, while you're trying to refinance something at a lower interest rate, you're moving in the right direction, but you just can't afford to have no credit card debt right now. You may be able to afford to set a calendar reminder for the day before your statement date to pay it at that point in time so that at the point that they check your credit utilization, it's as low as possible. That one thing may increase your credit score just enough to refinance the debt because your credit score has increased. Are you tracking with me? It's just little tips. The goal is to make sure that you have none at all and that you pay everything off month to month to month. But just because that's the goal doesn't mean that's where you are right now. This is incremental, actionable progress, right? How are we going to make 5 talents into 10, 2 talents into 4? Because I guarantee you the master didn't leave and the person who had 2 talents automatically then had 4. It took some work, right? That's what we're trying to do. Next slide. Now, let's talk about some other things, incremental steps while we are building towards the ideal of no credit card debt that could help you. I'm going to tell you, I want you all to be clear. I hate debt. Not to the extent that I think that there's not some good reasons to take it out, but to the extent that I don't think we should be slaves to it. So this is not about me encouraging you to take on debt for debt's sake, right? But this is just how do we use the rules that we have at our disposal to benefit us while we work towards the ideal. You guys have heard of personal loans, right? Personal loans are not something that you take out to just go buy something you don't need. But in the sense of using them to pay off credit card debt, there are some real positives in some scenarios, if you can afford the payments. We talked about credit utilization. It's an assessment of how much of your available credit you've borrowed at a particular point in what? In time, right. What we did not share is that everything is not a part of your credit utilization calculation. Credit utilization assesses your revolving credit. That's debt that you can borrow over and over and over again. If you have $10,000 available on a credit card, you can borrow $10,000, pay off $10,000, borrow $10,000 again. A personal loan is installment debt. If you get a personal loan for $10,000, you spend that $10,000, it's gone. Credit utilization does not assess installment debt. So let's say that I have $10,000 on a credit card. It's killing my credit score. There's other debts that I want to repurpose so that I can lower my total interest rate costs. If I were to take a $10,000 personal loan and use it to pay off $10,000 of credit card debt, when it comes to credit utilization, that $10,000 has completely disappeared. It's not assessed. That alone can also increase your credit score enough to give you some margin to do the things that you need to do. We have to be realistic. This might be the most sacrilegious thing I say on this stage, hopefully. There are people who I know who have done financial peace 50 times. That's an exaggeration, but like many, many, many times. And have never confronted the fact that it might work for a person. It might have worked for some other people. But if it hasn't worked for you and you've done it 6 times, how long are we going to wait to find something that's actually actionable for you, right? So it's no disrespect to the method. It is it the right method for you? I can tell you, we're going through some things with my son right now. I was talking to my friends last night about it, and it's like we're talking about things for his development, and we look and we say, hey, as we evaluate something, the first question is, what is the benefit of this method? The second question is this the right method for my son? I don't care about anybody else's kids, right? I care about, is it the right method for him? It's the same way with financial literacy. Now let's talk about credit card surfing. We're not going to talk about credit card surfing. That's something that we need to do when we have more time to talk about personal finances, because it's very involved and it's more dangerous than helpful if a person doesn't know themselves. So today we're going to talk about personal loans in the sense of using them to pay off credit cards, because this is something where you can take actionable progress. When do I pay my credit cards off? I pay it off the day before my statement ends. If I'm trying to lower the total cost of my debt, I can consider looking into a personal loan. I will have a date by which I will be out of credit card debt, right? It's installment debt. Once you pay it off, it's gone. How many of you would love to know the actual day and time where you would be free from credit card debt, right? So that's what we're looking for. And it could improve your credit enough to potentially reassess your other debts. Next slide. Maximum liquidity. Next slide. How are we going to make sure that we have maximum liquidity? This, again, going back to the method, you all have heard, put $1,000 in a bank account and don't save anything else until you have paid off all your debts. And then you come across a $2,000 emergency. So where do you have to go right back to? The same credit cards that you're trying to pay off, right? How many of you all have tried to start an emergency fund and also tried to pay off debt, and then something happens that depletes the emergency fund and causes you to go back further into debt? How has that happened to anybody? Come on now. I do this for a living. It's happened to me. Thank you. All right. So to me, there is an imbalance in motivation when it comes to how we pull ourselves off the pavement when it comes to making financial progress. Many of us see financial progress, and there is a true emotional component to being able to pay off a debt. It's one of the most beautiful feelings in the world, right? This has been on my back. I paid it off. We don't seem to have that same emotional attachment to seeing our savings account go up an additional $1,000. And when we're trying to get motivated, we chase the feeling that keeps us going, right? It's very natural. So we pay off debt aggressively, and we don't consider the fact that there was behavior and circumstance that led us to this debt. And the only thing that can break that behavior is money in your pocket. I promise you, if you got something that you need to pay for, they will not accept at the register. But I paid credit card debt off $1,000 last month. They don't accept that currency, right? So you have to balance with a higher tilt towards savings, increasing your emergency fund before you aggressively attack debt. It's not about doing one or the other. It is about what is the priority. The priority is not to pay off the debt, it's to get out of debt once and for all. And the only way that I can get out of debt once and for all is if I pay it off while having the capital to ensure that if another emergency arises, that I can use that capital to pay for it. You have to make sure that there's a balance, but the balance needs to tilt towards savings. And then next, debt to income ratio. This is about maximum liquidity. How many of you all have had a debt that you became motivated to pay off, and maybe you had 10 years to pay it, and you say, I bet if I really get aggressive, I can pay this off in 5 years. Has that happened to anybody? How many of you have gone the extra step of refinancing it so that you have to pay it off in 5 years? Anybody done something like that? After you've taken that step, ever got to a month where you're like, ooh, this new payment, you know? Ooh, this might not have been a good idea. Now I don't have as much flexibility as I had before. My interest rate might be 1% lower, but my payment is $200 a month higher. Here's what that's done. It has increased your debt to income ratio. So now, because of your motivation, you have robbed yourself of all liquidity. When we meet with people who are trying to pay debt off, we say the interest rate is one consideration, but the required minimum payment is the second consideration you have to keep in mind. If your required minimum payment is so high that it prevents you from addressing other areas of your finances, I would rather you have a higher interest rate and just pay extra so that when an emergency arises and you do have to buy those 4 new tires, that's my favorite example to use, by the way, you'll understand that. But when you have to buy those 4 new tires, you will be glad that you didn't switch that 10-year payment to a 5-year payment, because now your payment's still the same, even though you've been paying extra, and now you can't pay extra, but you don't have to pay extra. That's a lot different than now I can't go backwards, right? I've already become too aggressive. Debt to income ratio is the second element that banks look for. Credit tells them what interest rate you might receive. Debt to income ratio tells you how much they will lend to you, because that lets them know here's how much extra they can afford on this budget without being stretched. And when you increase your debt to income ratio, you are basically saying this ship is taking on water and I can't have much more. Otherwise, everything's going down. So no matter how motivated you are, you have to protect your debt to income ratio. Next slide. We're going to skip the student loan slides because we're going to talk about that separately at the end of this portion. Next slide. Next slide. All right. Positive improvements in net worth. Next slide. This is about moving in the right direction. How do we make those 2 talents 4 talents? How do we make those 5 talents 10 talents? The first is we have to take advantage of free money, right? If you have built yourself up, no, listen to what I'm saying. If you have built yourself up to the point where you can contribute to your employee retirement account, I'm gonna stop right there. If you have built your savings up to the point where you can contribute to your employee retirement accounts. Why am I saying this multiple times? Because one of the last things people stop doing when they're motivated to get out of debt is put money in a 401k. There's a match in my company. If I don't put money in, then I'm not gonna get that 3% match. You are saddled with credit card debt. You have nothing in savings. If you have a $50 emergency tomorrow, you can't cover it. It might be worth giving up that retirement match for a few months while we get ourselves together, right? So if we have put ourselves in a position to take advantage of our employer retirement accounts, then free money is there with a retirement company match, right? If I put in 3% of my pay, they'll match 3% of my pay. That's free money. They did a study with people of over $1 million in their 401ks a few years ago. And what they found is, on average, those people had almost $250,000 in their account that came from retirement matching. $250,000 of somebody else's money. It's powerful. So don't give up free money if you're in a position to participate in these plans. Does anybody have access to a health savings account, flex spending account, or dependent care flex spending account at their job? All right. Is there anybody, we'll just pick one of these accounts. Is there anybody with access to a dependent care FSA who has a child and doesn't use that account? Okay, I want to make sure. Now, a dependent care flex spending account is just one type of account that you can use for certain expenses. And when you use it, it lowers the amount of income on which you pay taxes. You can use a dependent care FSA for pre-K. You can use it for school registration fees, summer camp. If you have elderly parents, you can pay for someone to come watch them during the day. You can use it to pay for babysitters. All of these things that you can use it to pay for, all you got to do is just put the money in the account and then pay for that thing, and you don't pay taxes on any of those dollars. Flex spending account. Does anybody know that Target, Amazon, Walmart, Kroger, they all have separate pages of their website dedicated to just the products that are eligible to be paid for with FSAs and HSAs? You can have money in those accounts, and everything you pay for on that page, they've already cleared it for you. It's eligible. If you pay for it there, you don't pay taxes on it. Does anybody know why the health savings account is one of the most flexible retirement vehicles that we have? Health savings account. Health savings accounts are accounts that you have to use for eligible health expenses before age 65. But after age 65, you can use it for whatever you want to. You can invest the money in your health savings account, and many people do not. The money that you don't spend from year to year rolls over. As it grows, you don't pay taxes on it. So it could have triple tax benefits. You don't pay taxes on it when it goes in. You don't pay taxes on it while it grows. If you use it for health expenses, you don't pay taxes on it when you take it out. And we're struggling to come up with the copay when we go to the doctor. But we're not using our HSA. Investment returns and market dependency. We'll leave it here. I'm not going to ask you to call yourself out. It doesn't have to be, I'm not anti-crypto or any of those things, but just insert unnecessary investment here. How many of us have participated in something that we thought was was just going to fly to the moon in terms of this investment while we were saddled with credit card debt? Right? Like, I took this opportunity, this thing is going to go to the moon, and we still are struggling with the basics, right? There is something to the idea and the benefit of doing things slowly, right? If you have not learned the lessons yet, what you receive in the end will be spent. They've gone back, all those people who had those meme stocks, you know, a couple years ago, you remember that? All those meme stocks. Hey, I bought, what were some of them? With Robinhood, there was like a movie theater stock, AMC. All these people bought stocks to become instant millionaires overnight. They've done exposés on those people. Most of them have already lost all that money. They didn't learn the lessons of what it took to not just establish the wealth, but maintain the wealth. There is benefit to doing things at a particular pace. Just because your friend got a 20% return last month, if they can't explain how they got that 20% return to your child, they don't understand it. Okay? Next slide. All right. Next slide. We're gonna go through some of these just for the sake of, I want to make sure you all have questions that you can ask if you have them. Here's something that I really want to focus on. Protection from death, disability, and creditors. Maybe this is just some of the things I've been dealing with recently in life, with friends, with family, with clients who, you know, I say it jokingly, but it's a very real thing. There's people dying that never died before, right? like, what is going on? You know, like there's a guy I used to work for who used to say, man, you hear about such and such? They went to bed and woke up dead. You know, like it's just there's things happening where it's like you never thought that you'd be in this position at this point in time, having to prepare for things. And that's the point. We don't know when it comes. Next slide. I want to tell you why this is so important. There are selfish purchases when it comes to insurance, and there are selfless purchases. Disability insurance is a selfish purchase. I'm trying to make sure that if I am ill or unable to work and I can't earn an income, that income is replaced, right? That's why you purchase it. Now, you may use it so that income can feed your family, so on and so forth, but like, you're alive, you want to benefit from it. Most disability insurance policies replace 60% of your take-home pay in the event of an illness or an injury. Now, here's some of the things that people don't realize about a lot of this. Many of us work at places where our company pays for our disability insurance. So it's replacing 60% of our pay, but if they pay for it, that 60% is also taxable. So we took a 40% pay cut, and then we pay taxes on that remaining 60%, right? Not ideal. We also are not aware that it doesn't cover overtime pay. How many of you work hourly and depend on overtime pay as a part of your compensation, right? It also does not cover bonuses. It does not cover sales commissions. So you could have a significant portion of the income on which you depend completely uncovered by a disability insurance policy, all because you were unaware of its benefits. Does anybody work in here work in a subset of a specialized industry? An example would be like I'm a mechanical engineer or a pediatrician. Somebody in here should raise their hand. All right, so I know some of the people in here, that's the joke. So here's the thing about having subsets of an industry. If your disability insurance policy is not structured appropriately, you could be, say, a mechanical engineer, be disabled, and before the company will pay your claim, they may say, are you able to do anything based on your level of education? Not your job, based on your level of education. For some people, that might mean, yeah, you can't do this job right here, but can you teach? Well, yeah, I can teach, but I make a fourth of what I make now. Yeah, but you technically can work, so we're not gonna pay you, right? Here's the difference. Let's say that we have a pediatrician who has protection on the fact that they're a pediatrician. Now they're hurt. They start collecting 60% of their pay as a pediatrician. They can work. So maybe they become a professor at their local medical college. Maybe they're making $150,000 a year. They can collect the full $150,000 and still collect 60% of their pay as a pediatrician, as long as they can prove that they're not in patient care. If you're telling me that in the event of an illness or injury, this policy is the one thing that's going to keep me whole, I am going to read every detail of that policy. How many of you have read every detail of your life insurance or your disability policy? Probably not many of us, right? But it's important. Life insurance. My grandfather is 92 years old. He tells stories about, and some of you may remember this, there were no online payments. There were no mail-in payments for life insurance. They would come to your house and collect the premiums. Like they would knock on the door and they would come to your house and collect the premiums. He also tells stories about people who would pay those premiums for 20, 30 years, die, and they wouldn't pay the claim. They'd find a way. This is documented. There have been lawsuits that have proven that insurance companies have preyed on minority communities, sold them policies they didn't understand, collected the premiums for years, found a way to not pay the claim when the people died. Now, if that was your background, I'm not saying it's right. I'm just asking you to understand that there's a reason people say the things they say. If that had happened to your mother or your father or your sister or your neighbor again and again and again, would you not understand why a person might say, when it comes to life insurance, I don't want nobody to be rich off my death. I'm not trying to pay for my wife's next husband's house. I only need enough for my family to bury me, right? It's not right, but can you at least understand why they might say it? If something like that happened to their father and they spent all that money and never got it back. So that's why they might say it. But let me tell you this, insurance is the most cost-effective way to transfer risk from yourself to a third party. For pennies on the dollar, I can transfer the risk that I might die and my wife and son may not have the money that they need. I can transfer all of that to an insurance company. Now, I may say I want my family to have $3 million when I die. I can wait until I can save $3 million, or I can pay an insurance company $100 a month, and if I die tomorrow, that money's there. Now, people will say maybe you get to the point where you don't need insurance. Absolutely not. There are two things that can occur that would make you need life insurance. One is you haven't done as well as you thought. The other is that you've done better than you thought. Let me tell you why both are relevant. If you've done better than you thought, every person in here who's done better than they thought has somebody in their family who needs some of that money that got them better than they thought. They haven't done as well. You've got them accustomed to a certain lifestyle. Or maybe you have family property, but you want to leave it to 3 different people. One of those persons wants the house, the other 2 don't. How do you split a house in 3? Life insurance, right? Either they're going to refinance the house and take the equity out and destroy the investment that you built, or they can say, this house is worth $300,000. So we got a $200,000 life insurance policy or a $300,000 life insurance policy. This person can keep the house. They can use the money from the life insurance to pay off the other 2 people to equalize the inheritance, right? That's one example of I've done better than I thought, I need life insurance. Now let's say I've done worse than I thought. I'm to the end of my life. I want to leave a legacy, which is a biblical principle, right? Like the things that we say, we come here, we learn about the Bible, we pray, but then we say things like, my family only needs enough to bury me. That's not biblical, right? Inheritance to who? Children's children, right? And if I haven't saved up enough, does that rob me of that responsibility to provide that inheritance? So why not just get some life insurance and equalize it? I didn't do what I wanted to while I was here, but I paid $50 a month for 20 years and my family got $250,000. I fulfilled my responsibility, right? We have to take this seriously. But so many of us, instead of getting our own coverage, we depend on the coverage that we have at our job, which might be 1 or 2 times your income, right? You get a policy, it's 2 times your salary. So you're saying that if something happens to you, your family has 2 years worth of your pay, and then what? And then what? I mean, let's just think about it. It sounds good when we find out that it's only $2 a pay period. But think about that 3rd year after you die. What then? We have to get our own coverage. Next slide. This is the last one, and we're going to open it up for a few minutes of questions before we finish with student loans. Estate planning. I can tell you this. I don't even have to tell you this. I'm going to ask you all who have buried people in your life to just be transparent about something. Has there been a time in your life, and the older you are in the room, I just would find it unlikely that there hasn't been. Has there been a time in your life where you have been helping or you have been the one to manage the affairs of a loved one who has passed? Anybody? Now, I'm not going to ask you to raise your hand for all of these next ones, but has it ever happened to you and that person had not taken care of those affairs? No will, no life insurance, or you can't find the will, can't find the life insurance, had bank accounts but you didn't know where they were, had debts that you were not aware of because they didn't tell you they signed up for them. Has that happened to anybody? Now let me ask you this, and I don't want you to raise your hand on this. You love that person, you grieve that person, you care for that person. That person is not perfect. But at some point in that grieving process, when you're managing affairs that they could have taken care of while they were here, there's an anger. There's an anger. And it's rightfully placed in my mind. It's a part of the process. I could be grieving this person for grieving's sake, and now I'm going back and I'm dotting I's and crossing T's that it would have taken them an hour to do while they were alive, right? There's no excuse to not have these things anymore. You can get a will in 30 minutes for a couple $100 if that's where you are. I'd prefer you go to an attorney in person, but if you just have to have something, a couple $100 in 30 minutes, right? There are reasons that you do these things. It's to protect your loved one's ability to grieve while you're gone. I tell the story. The same person who said, such and such woke up dead, had a sister-in-law. Sister-in-law goes in for a routine procedure, has a complication, dies on the operating table. The night before, she had parked her car in their driveway, and they drove her to the hospital in the morning for the routine procedure. She dies. They couldn't figure out who had the car loan, couldn't figure out who had the title, couldn't have anybody come open the car and tow the car because they didn't have the ID that matched the title. They didn't know where the title was. They couldn't prove ownership of the car. That car sat in their driveway for 6 months. They're just having to drive around it to get into the garage. Now, you love that person. You grieve that person. But every time you pull around that car, you're just saying, come on. Like you couldn't just told me where your car title was. Like these are things that you have to take responsibility for. It also protects your family from future squabbles. Multiple times. Multiple times. We have seen people who even tried to plan, got a life insurance policy, had a retirement plan at their job, was married to one person. That was the person who was their beneficiary. They divorced that person. They remarry. They die. They never change the beneficiaries. You got children from a new spouse. You got a new spouse. They have to go back to their partner's ex-spouse and say, can you give me that money? And guess what? They have no legal obligation to. They have no legal obligation. They had a direct beneficiary. It's not something that's assessed by the will. It bypasses the probate process. If they want to keep that money, they can keep that money, right? You die. You have no will. You have minor children. The court doesn't know who to put over the finances of that minor child because they can't do it themselves. They pick the least financially responsible person in the entire family because they don't know. They just know, that's their grandmother. They don't know that this person has filed bankruptcy twice, is struggling with all these finances, really needs that money more than the kids need that money, and now has access and control over that money. And if there's no one else in the family to take them to court over it, they could spend the whole thing, and the judge never is the wiser. These are things you have to think of. You need to make sure you don't disinherit your loved ones. You need to make sure you plan, because I can assure you, if you do not take these steps, there will come a point in time where when someone is supposed to be grieving for you, they are instead trying to process that anger. So now let's finish this with the text. Next slide. What part did we leave out? Remember, there's a part that we did not mention in this story. So we're going to show it now. Next slide. It said, for it will be like a man going on a journey who called his servants and entrusted them to his property. To one he gave 5 talents, to another 2, to another 1, to each according to his ability. When we talk about this parable, we talk about stewardship. We talk about what the person did after the master went away. I got 5 talents. I made it 10 while you were gone. I had 2 talents. I made them 4 while you were gone. The person who had 1 talent didn't increase his talent. But let's talk about why the master gave them each of those numbers. God knows the end before the beginning, right? So God had to have known what these people were going to do with these talents before he left, right? So why did he give the person 1 talent? He gave it to him because he looked at what they thought of the gift they received, their responsibility toward that gift, their love for the master, their understanding of why the master gave them that gift in the first place, right? They looked at their entrepreneurship. They looked at their dedication to their craft. They looked at their stewardship, and they said, I already know this person's not going to do anything with this money. So why would I give them 5 talents in the first place? I could give those extra 4 to the other 2 servants because I know how they treat what I've given them. What if you found out that the level of opportunities that you have at your disposal is all about the mindset that you take and the responsibility you take for the opportunity in the first place? And if you would just think more of yourself, think more of your ability, think more of your responsibility to what God has given you, then you could have gotten 10 talents. He didn't say that they had to make more. If he had given 5 and the person had made an honest effort and had reduced it to 4, do you think he would have been mad? I don't think so. If the second set of those parables is the boy went away from home, lost all the money, came back home and got a party and a hug, right? So it's not about having to get more talents. It's about making an effort to do so, right? So instead of getting 1 talent and being upset that someone got 2, or upset that someone got 5, if you would just say, when you leave, while you're gone, until you come back, I'm going to do the best I can to make this 1 talent 1.5, or this 1 talent 2, then you might find that before he leaves, the master might say, here's 2 more, right? It's all about mindset. It's not about perfection. It's not about a wealth message. It's literally just about what do you think of the gift that you've been given, no matter how small the gift. And if you have an appreciation for it, the opportunity that comes after the master is gone could be even bigger. Okay? I'm going to open up for questions. You have to come to the mics. because it's being streamed. So people won't hear your question if you don't come to the mic. So any questions, and then we'll take a few minutes and we'll do about 25, 30 minutes of pure student loans. Any questions? I was either that good or that bad.
Just on the portion where you mentioned what banks expect, how do I calculate my debt to income ratio? Can you break that down? Right.
So there are two parts of debt to income ratio. Hey, Auntie. There's front end debt to income ratio, and then there's back end debt to income ratio. Front end debt to income ratio, you take your housing costs. So mortgage, property taxes, if you have an HOA fee, all of that's included. You take that number and you divide it by your income. So for example, if your monthly income's $5,000 a month and you have $2,000 of housing cost, your front end debt to income ratio is 40%. Back end debt to income ratio, they take all of your debts and they divide it by your income. So if you have $5,000 worth of debts and then you have $5,000 worth of income, it's 100%, so on and so forth. So there's two different parts of it. When you're applying for a house, front end debt to income ratio is really important. For all other forms of debt, when they say debt to income ratio, they're talking about back end debt to income ratio. Total debts divided by total income.
My question has to do with, and thank you, by the way, for the wonderful explanations. My question has to do with, once a credit card is paid off, it's it's zero balance. If you were to close that account, why would your FICO score increase? Decrease.
So the question was, if your credit card balance is at zero and you close the card, why does it make your credit score decrease? The reason is because 15% of your credit score is the age of your accounts. And when you open that line of credit, it had a birthday. And the longer you have it open, it benefits the age of your accounts. And when you close that account, it strips all of that history from your age of accounts. So to me, if you're determined to not use a credit card, I often tell people, find like the smallest bill that you have, because they will close it for you if you don't use it. So I tell people, buy a tank of gas a month with that card, or put your smallest bill on auto pay on that card and put the payment on auto pay as well, just so it keeps that line active, but you don't want to close it.
So quick question. First off, great presentation. Can you talk a little bit more about the process of creating a will? And if you can just add on top of that, there's concepts about a trust. How does that all come together? Just so much information.
Yeah, I'll try to keep this high level because trusts can get complicated. So a will is a document that instructs a probate court on how to distribute your assets. Even if you have a will, you still got to go through probate. It just makes it a lot easier. They have the will, they get the will, they just follow it according to the will. So it's still helpful to do a will, to do advanced medical directives. All of those things are really important, but you still have to go through probate. Now there's two types of trusts. Well, there's a bunch of types, but there's two camps of trusts. There are what's called inter vivos trusts, which mean this is a trust that exists while I'm alive. Inter, while, or in between, vivos, life. Inter vivos trusts are standalone. They exist outside of your will. You have instructions to how the things that are in the trust are going to be paid out. Plenty of people love them. People put property in them. I'm not going to get into how to use them, but just that's one type of trust. There are also trusts called testamentary trusts, and those are trusts that are created by the will. They do not exist until the will has been addressed. So for example, my family, we have testamentary trusts. When a probate court reads my will, if something happens to me, they're going to see that after I die, I want a trust created for my son. And I want any money that I leave to my son to go into that trust. And I want that trust to be something that before he accesses the funds, he needs to actually go through my wife's brother. right? And I want to make sure that that exists until he's 25 or 30 years old, because at 18, I may not think he's responsible enough to have the money in that trust. Here's another thing that that does. Let's say that I leave money to my son in that trust, and he keeps it in that trust, and he marries someone, and maybe he's an idiot, or they're an idiot, or they're just not a good fit, and for whatever reason they split. Any money that I left him in that trust is off the table. Same for my wife. If I leave money to my wife, a trust is created. She has full access to the trust. If she marries someone, divorces that person, they have no access to the funds that I left my wife.
The question I had about the credit card situation, if you have a credit card balance of, let's say, $5,000, and you don't pay it completely off, the entire $5,000 balance, say you leave about $200 on the card, and you get a minimum monthly payment, a couple dollars a month, is that something that'll help sustain your credit score as well?
It would be helpful in the sense that it would help your credit utilization. If you have $5,000 that you could borrow, but you only owe, like a couple hundred, then that helps your credit utilization, but you also will be paying interest on that couple $100 unnecessarily. I mean, it'd be a couple dollars, but it's still, so like if you can pay it off, I would pay it off. I'm not a fan of like keeping balances on cards just for balance's sake. Like I said, get a pack of gum, buy a tank of gas, but then pay it off in full. There's no reason to just leave a couple $100 on the card. All right, we'll do one more question, then we're going to do student loans. Come on. Yeah,
Just had a quick follow-up regarding the credit card. Say if you have a credit card that you don't use, if you pay $1 on it once a year to keep that open, would that consider as activity to keep that or the credit card from closing that account versus just charging something just to charge it to keep it active? Is that another option?
Well, once a year, they probably would still close that card. And if they don't close the card, they will probably lower your credit limit on it, which can adversely impact the credit utilization. So to me, I would say just fine, even if it's like Netflix. You can set it up on auto pay so you won't forget about it. But I would prefer it be something that's like more consistent, just because if it's once a year, that they're going to close that card. Last question.
Hi. What happens to your debt when you die? Does it go to your family, like medical bills or anything like that? And how do you protect your family?
So the easiest one to answer is that federal student loans die with you. Your family doesn't have to pay off your federal student loans. The rest of that is a little complicated based on the state in which you live and how you took out the debt. If it's a joint debt, like we took this out together, your family still has to pay that. There are some states where even if you did not, like even if your name's not on the line, in the event of a divorce or something like that, it could still be considered a joint debt. So a lot of that is still state specific. The one that's the most clean is federal student loans. Things like credit cards, I don't want to go too far into this other than saying there are some debts where it's like, if you're not on it, there's really no recourse for them to get you to repay it. So it's kind of a fine line, because there are some times where it's like, well, it's a credit card. I mean, they can try to come after it, but there's nothing to come after. So it just kind of is what it is. Yeah, it just kind of dies with you. All right, so let's, the second PowerPoint that I sent, would you all happen to have that? Now we're going to shift to student loans. We're going to do about 25 minutes. Cool. Is that cool? Cool. All right. I'm going to get a sip of water while they're pulling that up.
You guys need to stretch?
Yeah. Do the stretch. All right, yeah. You want me to lead it? All right, you guys. All right, we're gonna get started. Give everybody 30 seconds to get back to their seat. We're gonna get this thing queued up. Yeah, next slide is that works for you? If that works. Yeah. All right, you guys ready? Oh, I got one. Thank you. All right, let's get started on student loans. Who has student loans? All right. Let's spend about 20 minutes going over some important things on student loans. We're going to focus on federal student loans for this portion. If you have private student loans, I'm happy to give you some resources. Before I get started, the good pastor had asked if I would make sure that I shared how you all can reach me, listen to more of what we do. So we have a podcast. We actually have two podcasts. The first podcast is the New Money, New Problems podcast. So that podcast, you can find it anywhere you listen to podcasts. The New Money, New Problems podcast. So that is the first podcast. We release an episode every single week. So one came out yesterday. There's another podcast we have called Escape Student Loan Debt. That comes out every 2 weeks. So a lot of the stuff that we're going to talk about on that podcast, we talk about in much more detail on that podcast. So if you like it, let us know you like it. If you don't let us know you like it. I don't like it. All right. So next slide. Now, we talked about in the first section the benefits of having a low debt to income ratio and having flexible payments. I would say that regardless of what your payment is that you choose to make for student loans, my preference is that you have the lowest required minimum payment possible. That's not saying you have to make that payment. It's just saying that there are benefits to having the lowest required minimum payment. Part of that is if it's revolving debt, which student loans are not, as we said, that can help with your FICO score. But even if you have a low student loan payment, it could free up funds to pay down your revolving debt to improve your credit score. So there's benefits to having a low required payment. We already talked about debt to income ratio. Next, we're gonna fly through a lot of these. Next. These are things that were also in the previous portion of the presentation. Federal student loans. There are a lot of things going on with federal student loans right now. Interest on student loans started back for the first time in over 3.5 years this month. Payments start in October for federal student loans. Now, with federal student loans, there are plenty of people who have been paying on student loans for 10, 20, 25 years, 30 years. They've watched their balances continue to increase. They haven't made much of a dent in their payments. There are things that are going on that are very time specific as it relates to all of those things. Next slide. Let's talk about income-driven payment plans. Even if you're not using these plans, there's a reason you need to know how they work right now. Next slide. Income-driven payment plans are payment plans where what you pay each month has no connection to your student loan balance. None at all. It's all based on a percentage of a number called your discretionary income. So for example, if I owe $1 million in student loans and you owe $1,000 in student loans, but we have the same discretionary income, we're gonna have the same student loan payment. Make sense? It's all about that percentage of pay. It's not connected to your loan balance. Now here's the other part of those plans. Conceptually, let's say that I do have $1 million that I owe, but because of the way these payments work, I'm only paying $50 a month towards it. There's no way I'm going to make a dent in that loan, right? The balance is actually going to increase. Well, the second part of these plans is that after 20 or 25 years of making payments on these plans, any remaining balances are forgiven in full. No limit as to the amount that can be forgiven. So you can have $1 million forgiven on these plans as long as you've made 20 or 25 years worth of payments on these plans. Tracking with me? These plans, because they are based on a percentage of that discretionary income, they require you to update that income with your loan servicer every year. In most cases, they use the income from your previous year's tax return to find that number so that they can update their payment to your most recent pay. Next slide. Here is why this is important to everybody, even if you're not on these plans. There are people who, because they've been pushed into these terrible payment plans, who have already paid their loans for 20 years or 25 years, or maybe they've been paying for 18 years, but they haven't done them on income-driven repayment plans. And if they were on one of those plans, they could already have their loans forgiven, or they might be 2 years away or 7 years away. But because they weren't, they have no credit towards forgiveness, right? Nobody told you about these plans, you didn't know how they worked, so you got no credit. But if you were on these plans, you could already be done with your loans. Well, thankfully, there's something called an income-driven repayment plan waiver. Next slide. This ends December 31st of this year. It is a one-time pandemic-era legislation. If you don't do it now, you will lose the opportunity to do it forever. Under this waiver, if you made any payment of any amount at any time, doesn't matter if it was partial, late, doesn't matter what payment plan you were on, they will count it towards your 20 or 25 years that you need towards forgiveness on an income-driven repayment plan. So it's saying you had the wrong plan, we're still going to give you credit, right? So that means that if you've been paying for 26 years, even if it's the wrong plan, even if in the past you had no credit towards forgiveness, if you take the steps to be a part of this waiver, your loans will be automatically forgiven. We have worked with people who have had almost worth of $1 million worth of student loans forgiven in the last 5 months from programs like this. Deferment and forbearance. Anybody ever had a student loan in forbearance? Anybody ever done it for a really, really, really long time? That wasn't supposed to happen. student loan servicers are not supposed to be able to put you in forbearance for longer than 12 months consecutively and 36 months cumulatively over the course of the loan. But I know people who have been in forbearance for 10 years. Now, as a part of this waiver, anything that exceeds those periods, 12 months consecutively, 36 months cumulatively, they're counting it as if you paid, right? So if you've been in student loan forbearance for 10 years, you're only supposed to be in it for 3, 7 years worth of non-payments are now counted as if you paid towards your 20 or 25 years. Here is all you have to do to be eligible. You have to have a federally owned FFEL loan. I know that sounds weird to have a federal loan that's not federally owned, but there are federal student loans that are owned by private entities. So you have to have a federally owned FFEL loan, or you have to have a direct loan. Now, to me, because it is very hard for a layperson to figure out if their FFEL loan is federally owned, the safest thing to do in most situations is if you have these old loans, just consolidate them into a direct loan. Any ineligible loan can be made eligible. If you're looking at this and saying, oh, I don't have that loan, any ineligible loan can be consolidated into a direct loan, which is eligible. Make sense? But you have to do it before December 31st of this year. If you have ineligible loans, you have to consolidate them before December 31st. Otherwise, it does not count. Tracking with me? All right. Now, next slide. Before we even go to this, does anybody have student loans who either works for or has worked for a nonprofit or a government entity? There's also a program called Public Service Loan Forgiveness. If you are wondering, oh, I heard that doesn't work, it works. We've had people that we work with who have had their student loans forgiven under Public Service Loan Forgiveness. The reason people think it doesn't work is because they don't know the rules. And when they apply to have it forgiven, they haven't been following the rules. The rules in typical times for Public Service Loan Forgiveness is that you have to be working. Now it is at least 30 hours a week for a nonprofit or a government entity. Used to be whatever they consider full-time. Now it's 30 hours. So you have to work for a nonprofit or government entity for at least 30 hours a week. If you work at multiple government or nonprofit agencies, you can combine for 30 hours a week, okay? You have to be doing that while paying your loans under one of the income-driven plans that we just talked about. So you have to be paying your loans on an income-driven plan while working for a nonprofit or government entity, and you have to have direct loans. Remember, that direct loans thing is very important. You're hearing this. Now, in order for that payment to count, you have to have all 3 of those things in place at the same time. If you have 2 of the 3, the payment doesn't count, historically, right? The Public Service Loan Forgiveness waiver says just like the income-driven repayment plan waiver, as long as you can prove that you made a payment while working for the nonprofit, we're going to count it. Same thing with the forbearance rule. As long as you can prove that you worked for the nonprofit or the government entity, they'll count it. Now, technically, this waiver ended last Halloween. But what they're saying is if you do what you need to do to be eligible for the income-driven repayment plan waiver, which is December 31st, we'll give you credit towards Public Service Loan Forgiveness as well. This is why some of the people that we worked with have seen those payments wiped away, right? Like, hey, I worked for nonprofits for 15 years. My student loans were in forbearance for 8 of those years. So I've only made 7 years worth of payments. Well, it's like, yeah, but that payment of 7 years plus the extra years that you shouldn't have been in forbearance equals more than 10. So these people could have had their student loans forgiven after making 7 years worth of payments, no matter the amount. These are things where if you have ineligible loans, you need to consolidate them before December 31st. If you're trying to qualify for Public Service Loan Forgiveness, you need to also make sure that you have verified your employment by December 31st. That means there's a form that you can find at studentaid.gov, studentaid.gov, and you can do it online or you can fill out a form. You can even send it for e-signature. It's called a employment certification form, and it just certifies the dates that you worked for these entities, and then they use that along with your student loan history to figure out if you've made 10 years worth of payments. This has to be done before December 31st. We good? All right, now let's talk about how these payments are calculated. The payments for income-driven repayment plans. If you are struggling to make student loan payments, income-driven repayment plans are likely your best bet. And they have come out with a new one that is going to radically reduce the payments for many borrowers. I told you that it's based on a percentage of your discretionary income. The way they calculate that is they take your adjusted gross income, which is on your previous year's tax return. You don't need to know it. As long as you have a tax return, they can find it. They subtract, in old times, 150% of the federal poverty level. The most aggressive, most cost-effective plan that they had allowed you to deduct 150% of the federal poverty level. That's an amount of income based on the number of people in your family where if you make that or less, you're considered impoverished. You don't need to know it. They'll calculate it for you, but that's how they calculate it. The most aggressive plan or the most cost-effective plan that they had was 10% of your discretionary income. So before this new payment plan, an example of this was, let's say you have someone who makes $50,000, you would subtract from that $50,000 150% of the federal poverty line. That's the federal poverty line for a family of two. It would give them a discretionary income of $20,000 or so, and they would pay 10% of that number, which would lead to a monthly payment of $170 a month. Now let's see what the new payment plan allows you to do. Next slide. They came out with a plan called the Saving on a Valuable Education Plan, the SAVE plan. Next slide. This plan, if you have just undergrad loans, you only pay 5% of your discretionary income. If you have just graduate school loans, you pay 10%, which used to be the most cost-effective payment. If you have a blend of the two, they take a weighted average of those loans. That gets really complicated, but just know that it's not going to be a pure 10% or 5%. But they also increase the amount that you can subtract from your income. Instead of 150% of the federal poverty level, it's 225% of the federal poverty level. So let's see what it would do to a payment of someone in that same scenario. Next slide. A person who has just undergrad loans in this scenario would go from a payment of over $170 a month to a payment of under $25 a month. So remember, it doesn't matter what you owe. This person could owe $100,000 in student loans. If they're paying $25 a month and they do it for 20 or 25 years, their student loans are going to be forgiven. Okay? This is powerful stuff. So you need to know these things. Now, I'd rather leave the last 5 minutes or so we have for questions, but I will say this. I talked to Myron about this. A lot of people are worried about student loans as we restart. We are actually doing, for Escape Student Loan Debt, we are doing a live course. It starts Tuesday. We're going to do this coming Tuesday and Thursday, and then the following Tuesday and Thursday. If you sign up for it, you get access to the recordings. I talked to Myron. I'm going to give the link for that course, and we'll do GRACE as the discount code, and you all will get 80% off that course. So it'll probably be maybe, I think that would make it like $50 or something like that. These are live, so I will be there. You'll be with me for probably about 6 hours worth of student loans, so you'll be able to ask specific questions about your loans. So if you have questions, come up and ask them, but I would encourage you, if you want to do a deeper dive, that's something that we have coming over the next couple of weeks that we would love for you all to join. Any student loan questions? Yes. Yeah, I'll give you the link.
I'm concerned about the recent student loan forgiveness. Mm-hmm. The amount that is forgiven, is that looked upon as taxable income for the next filing year?
So there is a freeze. So the question is basically, let's say that I do have $100,000 worth of student loans forgiven. Do I have to pay taxes on that $100,000? Right now, it used to be yes, except for public service loan forgiveness. Public service loan forgiveness, there's no taxes. Under income-driven repayment, you would pay taxes. It would look as if you earned that extra $100,000. There is a freeze on that so that until the year 2026, any student loans that are forgiven before that time, there is no tax. They will likely, who knows, but on both sides of the aisle, there's talk of extending that. So, if I were a betting man, I'll say were, then I would say that it's likely that they extend that. But right now, until 2026, if it's forgiven, no tax. Yeah.
Hi, good morning. If I plan on retiring, or say, for example, if I become disabled, do I still have to make my student loan payments?
If you are totally disabled, totally and permanently, meaning you cannot work in any profession, then they will wipe it away. But they use your tax return to check if you're earning. So you can't just say you're disabled. They can retroactively apply that debt if you have started working again. In terms of retiring, I will say this: if you truly understand how income-driven repayment plans work, there are a tremendous number of completely legal, in the statute ways to have a $0 payment that still counts towards forgiveness. Because if they calculate that payment and it just says that you make a $0 payment, it still counts as long as you signed up. So there are retirees who make an amount in terms of taxable income that is small enough that when they do that calculation, it leads to a $0 payment, and eventually that debt will be forgiven.
Yes, good morning. Thank you for coming out.
Thank you.
If you get married and your spouse, would they consider that income also?
So here's we talk about legal ways with the statute. It's not relevant in Ohio, but so yes, with student loan payment plans, if you are married and you file your taxes together with your spouse, then their income is included. If you file your taxes separately, which there are reasons that you wouldn't do that, so you want to make sure you do that with a tax professional. If you file it separately, their income is not included. But there are community property states, and in community property states, Texas, Louisiana, New Mexico, Arizona, I think Wisconsin is one. I don't think Michigan. But he was like, Detroit? But in those states, even household income is considered 50-50. So let's say that I live in California and I earn $100,000 and my wife stays at home and I have student loans and she doesn't. If we file our taxes separately, we have $100,000 household income, but it's 50-50 in California. So she gets a tax return that says $50,000 and my tax return says $50,000. So now when I apply for my income-driven repayment, even though I made 100, I only pay as if I made 50. So there's all types of stuff you can do. Probably got like 1 more minute of questions. Okay, so New Money, New Problems podcast, Escape Student Loan Debt podcast. We'll get the link to you for the student loan course. The code will be GRACE. We'll set it up before I leave so that you get 80% off. I appreciate you all having me. Hopefully this was valuable to you. Yeah, thanks.